Well, good morning. This is Tom Aspray from the Viper Report. Thank you all for joining me today. Originally, I had scheduled this session to talk about some of the indicators that I use, but given the stock market action, even though it was only 4 days of trading last week, I thought it might be more useful to all of you and appropriate to talk about stock market corrections and how you can understand them and better navigate them when they happen. They're just a normal course of the market, of course, and I've been studying them going back into the 50s, and many years ago I developed a set of guidelines and parameters that I use to understand and interpret them based on the advanced decline line. And so I'm going to give you a little introduction to that today. These numbers are not followed by a lot, frankly, and you'll find that if you become an expert in this analysis, you'll be able to be quite confident at what the market is doing, and often diametrically opposed to those you see on Bloomberg or CNBC. In fact, as you'll see, the AD lines have been sending pretty serious warnings for a couple of weeks, and a week and a half ago, one of the CNBC anchors said, well, I just don't understand why the stock market is declining. So hopefully you'll have a better understanding when we finish this. Once again, it's going to plan on being a short session, half an hour, 45 minutes at the max, and we'll try to stick to it. I will answer questions, so any and all questions, no matter what level, are welcome. So let's look at the first slide. I think you're all seeing this. So let's explain this chart. This is sort of a basic chart that I use in my publications from Trade Navigator. I will show you some charts from stock charts to show you how you can duplicate this as there. So we have a bar chart here, or a candlestick chart rather, of the S&P 500. These green lines are Stark bands, which is a tool developed by a late friend of mine, Manny Stoller, that helps you identify extreme levels of buying or selling. It essentially is designed to encompass about 92% of the price activity. So when you're near the lower bands, like you were February 9th of 2018, it's a high-risk area to sell, and it's a low-risk area to buy. So I use these for clients to say, if you're short and you're well below the Stark band, that's probably the time to take some profits. And conversely, I tell it to people not to chase buying near the upper Stark bands. So we see below this is the S&P 500 AD line. It's one of the 6 AD lines that I follow. One question I often get from my students in my AD course is, well, why do you follow 6? You get a little different picture. The 6, to be specific, are for most of the last 50 years, the only one that was available is the NYSE, what we now call all AD line. Some of you may not be familiar with the NYSE composite. Is one of the broader market indices. Last check, I think, had about 2,200 different issues, but there are a bunch of different things in there. There are ADRs, they're closed-end bond funds, and so it's not all stocks. So the AD line up till 2000 was just based on all those issues: how many were advancing, how many were declining. Since then we have another AD line called the stocks only AD line. So I follow both of those. I follow the S&P 500 AD line, which was just started to be available in 2009, the Russell 2000, the NASDAQ 100, and the Dow 30 AD line. So those are the 6 I follow, and I find that can be very advantageous in terms of determining which ETFs are going to likely to perform the best or worst. And therefore, if you're taking an option position, you know which one's the best one to buy calls or puts in. So this red line represents the S&P 500 AD line, and the green line is a weighted moving average of that AD line. So the relationship between the AD line and its moving averages are quite important. In late January of 2018, you can see we dropped below the moving average right in here and started to tail off right as the first couple of days of February. And we saw that tremendous slide. We went from 28.72 on the S&P down to 25.32, a good 340-point shellacking. When we got down to those lows, we were below that Stark band. And when I looked at, that was a Friday, we had an upside reversal, very weak, lower in the day, closed higher. That's another thing you should all be on the lookout when you see that. That generally marks a turn either up in this case or also down. I noticed that the AD lines, you can see right down in here, were acting better than prices. And my longer term analysis said that, you know, the bull market wasn't over and that this was just a correction. And but it was a very choppy spring, you know, throughout February, March, and April. You know, I kept revealing this sort of trading range in the AD line, you know, and this resistance line A, and was telling people that, well, you know, we will have a new buying opportunity. And once we get a breakout in these AD lines, it'll be time to get back in. And that occurred on May 10th. I think I wrote an article about it, particularly that earlier in that week, one of our larger following CNBC guys show, he was very bearish, looking for, you know, a major drop below 2,600 at that point. So oftentimes you'll find that you're in that position. This sort of breakout was confirmed by most of the technical studies and, you know, by a number of my students who were familiar with AD line analysis. And that, of course, started the rally that lasted until the end of September. So AD line, how do you calculate that? Well, every day, you can find it several different places from the Wall Street Journal. You can see, and this is from Friday, so it was kind of a rough day. You know, there were 1,330 or 3,030 issues traded, 915 up, 2,043 down. So every day you take the difference of the advances minus decline, and that number is added to the cumulative advance decline line. So for example, in that previous chart is easier to math. So let's say we're looking at the S&P 500, 300 stocks were up, 200 were down, then 100 would be added to the cumulative advance decline line. If on the other hand, 300 stocks were down and 200 were up, then 100 would be, a minus 100 would be added to that decline, the advance decline, so it would turn lower. So I monitor these on a monthly, weekly, and daily basis to give a good idea of, you know, what the major, intermediate, and short-term trend is. So day in, day out, I measure those and track them to give me an idea of what the market is doing and where I should likely be positioned. Let's look at last fall's activity, and then we'll so, okay, this is the NYSE composite. You know, same sort of setup here. There were some, you know, we had a divergence formed September 21st. You can see this line B. The AD line formed lower highs while the NYSE composite formed higher highs. That's a bearish or negative divergence. You don't always see that, but when you do, it adds more weight to the fact when you drop below the moving average, and that's what I say is called moving into the corrective mode. And then I look for a plurality out of the 6, you know, so if it's a negative, if more are in the corrective mode, then that turns my short-term trend analysis negative. That was the case in early October, and then we got the Powell comments, and you know, that were you know, really pushed the stock market to the bottom, you know. So we saw a sharp decline in here into the middle of October, reflex rally. There are tricks you can look at the AD line. That rally was identified by that, the AD line analysis. We'd see a sharp rebound. That would be likely a selling opportunity. We got another drop down into the end of the month, similar sort of situation. Pretty good price rally here, but the AD line was not as strong, stayed below its resistance, below this peak, and turned back down. And then, you know, another test of the resistance in late November, and then started to plunge into the end of December. This chart is as of January 4th, would move back above the moving average. So that was the first sign of a trend change. And, you know, now we're watching that resistance at this downtrend line C, and then more important resistance at this line B. So each issue of the Viper ETF or the Hot Stocks Report, this table's on the front page generally, covering, you know, the main market tracking ETFs as well as the NYSE, you know, the quarterly pivot levels. Written a lot about that. We won't go into it in today's presentation, but I can in a later one if you're interested, when you get my next survey, please put that down. 20-day EMA, it's important. So we look back, I tell people that, if that moving average is declining like it is right here, and you're thinking about buying, after this action here, this is telling you that it's way too early to buy, that it's not likely to bottom out until the 20-period exponential moving average flattens out. And, at this point, it was made a low, higher low, but still in a downtrend, a lower low, lower high. And, of course, then, rallies back to the 20-period EMA, I've written about this in the past, are usually good selling opportunities. So this table is out there, as of January 7th, 5 of the 6 daily AD lines were positive. 1 was negative. That was the stocks only. This arrow should be pointing downward, but it's still red, so that's the one part of it. All of the weekly AD lines at that point in time were negative. We were trading at 252.39. You fast forward a week, we're at 258.98 in the SPY, and now 4 out of the 6 weekly AD lines are positive, and all the daily are positive. So that was a really bullish sign. That was a sign, okay, it was probably time to get back into the market at that point. And we were looking at some tech, FDN, and adding to positions in XLY, etc. So one of the things that I think it's important with any method you use, I teach the methods that I've developed over the 30 years that work for me and consistently. But for anyone else, you really have to prove it to yourself. You have to look at something and look back and do the research and do the hard work. Just don't decide, oh, hey, it worked, in November. That's great. I'm going to do this forever. That generally, my experience, that's not going to happen. I was fortunate enough after I left biochemistry to have a great research facility to plow through, and it had most of the technical studies on it for years to develop the tools that I use and prove them to myself. Because only after you do that will you have the confidence to put real money on the line. So that's what, my AD line course, we hope to give you that confidence. In 6 hours of one-on-one training, we better, and we test you, so we hope that's the case. But this is sort of a similar formation. You'll see, AD line turned positive here. This goes back to 2005, but I can find examples going back into the 70s. So it turned positive right here. We've talked about before, this is also a doji buy signal right here. When you see that in the AD line, is bullish like that, that's really a great opportunity. So we had a nice run up into early March, and March 10th, the uptrend in the AD line was broken, as was the moving average, and we started a pretty good slide in the price chart as well as the AD line. It took looks like this is almost 3 weeks of trading. Got quite oversold, and there are ways you can identify that using the AD line analysis. So sometimes you got to the Stark band there, you got probably below it on this day too, and that was the time to say, okay, if I'm short, I'm going to start to cover and look for a bounce back to the 20-period EMA and back down again. So then AD line made a new low. Then we started to see some improvement here, in late April, slight new low in prices. AD line was higher, definite new low in prices. AD line was even higher, so you had a multiple bullish divergence here. May 18th, you moved above that resistance, and that was a sign that the decline was indeed over. So another good example is from early 2016. It was a really rough market. Late December, we were at 2081. By about January 15th, we're 200 points lower. This was extremely low bullish sentiment based on the AEI survey. I think down in the 17% range. I had to go back with my data to 2005 at that point to find a lower level of bullishness, of course, which I use it as a contrary indicator, and could be a topic for a future free video if you're interested. Anyway, the AD line had formed lower highs, dropped back below its moving average, gotten pretty oversold here. We were below the daily Stark band. At that time I said, okay, well, people were starting to panic. because it was, I said, yeah, I really don't think you should sell your long positions here. My long-term portfolio, I'm sticking with it. Got a very nice 2-week rebound right back to the 20-period EMA. So then what we were watching was the next decline. Well, on the decline into early February, the AD line formed a higher low here, so that was bullish. Wasn't really, a couple days later, it moved back above its moving average and this resistance where this arrow was pointing. And at the time, I wrote a article in Forbes. You can find if you search it. I think it was the title, "Is There Blood in the Streets Yet?" or something. Right at that point, and you had a really good opportunity for a second article right around in here, because the fast money, or sometimes I call them the slow money traders, were really bearish right up in here. This was just a rebound, and we were going much lower. And those of you look back at the financial headlines, and you can see search financial headlines January 2016. You see like this recession is going to be worse than the rest, and lots of gloom and doom here with that low sentiment. Sentiment was also quite low at this level. I think it wasn't as low as here, but it was close, like 19% bullish. And you had another good run to the upside. So let's see. We have a couple of questions here I think we'll take right now. I just read an article which states that this time is different from December because the VIX is only at 18 while it topped at 38 in December. So after over 6%, VIX is calm. Does it bode well or more pain ahead? I look at the VIX. I trade the VIX sometimes. I'm not convinced it means a lot right in here. The AD line analysis, I found much more reliable. So I wouldn't be surprised to see an explosion upward in the VIX, before, this decline is over. I wouldn't, that's my situation. So it's, it could be, it's what is closed at 18.5 or 19, and it's sort of in a short-term uptrend. It could surge to 22, 24 in a day or two, no problem. When the AD line has a steeper V shape, is it time to buy when it goes above the moving average? That's the method you teach your students. That's part of what it is, but it has to be, all the AD lines. And I look at the chart formation, and of course, it's a matter of risk, so that, if we look at this chart right here, for example, we moved above it right here. So this was that level right there. So, going in the next day's trading, I look at, whether, if my risk can be managed, and look at, it was a slightly higher low, and a few other things I look at if the on-balance volume is positive. And then, if I think, okay, if this is an important low and we're trading at, say, 1880, where can we get back to? Well, I think we get back to the old high. So that's 120 points roughly. And so, and from here we maybe had, 35 points on the downside. So risking 35 to make 120, 4-to-1, not wonderful, but, could be worse. More likely, I would probably look for this little bullish zigzag formation here that occurred right here. We got this. So after this day, it was really bullish. We got a quiet day right here, which allowed for an entry with a stop under here that was much more rewarding. This chart was instantly from September 14, made a new high, just very soon after that. Also noticed as the AD line was breaking down, we got another, a doji sell signal right here. And, that was important. And, so we went with it, and that was sound like the thing to do. So yeah. All right, so let's oftentimes and one thing keep your eye on multiple time frames is important. So basically every day I look at all the daily AD lines, of course, and I also monitor the AD lines during the day. Oftentimes you'll get very good signals if you're in and that allows, I have a couple of option traders that follow my stuff, and they can see when those things are happening, and therefore they get, they put on option positions right before the market turns around, which can be pretty exciting. This is a chart as of January 11th, so looking at the retracement level, so kind of, part of the risk reward analysis. What are the targets? The downtrend and the 50%, we're at 166.45 in the Qs. And more important, resistance around 170, 172. And one thing, I don't have a chart in this one, but is the AD line often leads prices. So, look back in here, it was acting stronger than prices. Right as this chart was put together, the weekly had moved above its moving average. The weekly AD line made a new high when the Qs were up here. So they were still, a good maybe 10, 12 points below the all-time high. But the AD line said, okay, we're going to take out that high, which we did, as I wrote at the time. So then you look at the weekly, and then you look at the daily AD line. You can see, some short-term formations. We broke that support there in December before the late December plunge. This had turned around in here and was, we were monitoring these resistance levels, and that was, a very positive sign. Okay, so let's see. Upper window, I think I closed those. Took the course and nailed the December low. He teaches all you need. Well, thank you. I don't know who that was from, but I appreciate that. Let's catch up on our questions. Yeah, I will be putting together a course, recording of this, probably early part of the week, maybe Monday. I try to clean it up. I try to zoom in on some of the screens, so it's not just a matter of, changing a file. But, I'll send out an email about it. And also, while we're on the topic, I will also, be looking at putting together a new survey. So I hope all of you will take the time to fill out that survey and give me your feedback, because I rely on that feedback to design these courses. So I will also put a comment section in there so you can say, hey, that was the worst hour I spent, or good, thank you, I enjoyed it. What about, you have questions about other things you'd like to learn about? That's where you can let me know. And I do appreciate your feedback. So that's a couple more, questions. About the AD course, yeah, it's a reduced thing for Wall 365. I think it's $8.99 for the course. I'll show you a link at the end if you're interested. Stark band moving, the Stark bands are a whole nother topic that I teach about. But I mean, oftentimes, I will use it, to if I'm taking profits. So I use a combination of the pivot levels and the Stark bands to exit positions. That's that's one of the techniques I do. And somebody says it is being patient. Yeah, it really has to be. It's choppy and downward like it is here. There's there've been some great selling opportunities, but buying has been very hazardous. And I'll get an updated chart. Maybe that's what we'll do next. So let's see. I think we're done, right? Okay, so I'm going to change screens here, and hopefully you'll be able to see the new screen. Let's see. Good. Okay, let's look at. So here's the the stock charts, AD lines. I set up a special page for my students and that, so they can go through and test. And the nice thing about stock charts is really, as I said, I don't receive any money. I pay for it just like everybody else. But you can have this feature down here. If you can see it down here, and it says predefined range, you can put in any time range you want. They have data, a lot of data, and see what happened. So if you're looking at the method, you can say, well, how did it do that way? So let's give an idea what transpired during this current decline. So I've been saying the market was stretched, based on a number of things starting in the middle of April and towards the end. I was really cautious about adding new positions, and did raise some stops. They were mostly hit early in May, and so this first red line, you can see, okay, let's tell you what's this. NYSE Composite 20 period EMA. Down below we have the all AD line. That's similar to the one you're looking in the Navigator platform, with a 21 period moving average. And down below that in red, you have the stocks only AD line with its moving average. So you can see the first thing was to roll over here was the stocks only broke this uptrend that went back to the March lows. We had a little correction in here, late February and March, and I didn't have the lines in, but then we broke out again, and that signaled the next push to the upside. So, the stocks only moved back above its moving average, but was not that impressive. And you can see the chart. What did I tell you about the chart, line before it? We had this rally back. The 20-period EMA was declining. That was saying, okay, this rally is not sustainable. This is probably a selling opportunity, frankly. So it chopped around, and then, the all AD line, it held up a little longer till a week ago last Friday, and it plunged below its support, its lows, and was sent a really bearish sign. So last week's article I published on Forbes.com, it said, will stocks lose even more or something in March? And it was based a lot on this. I was pretty confident they would. And so right now, there's really no signs yet of a bottom. You have a clear downtrend in both of these. We're getting oversold, and if we can add on the equivalent of the Stark bands on here. You remember stock charts, and that's all you folks write in about it, doesn't have Stark bands, so they have Keltner channels, and you have to change the numbers. This default is 6, 2, and 10, so you put in 6, 2, and then 15. And let's see, we'll make them in what color? How about purple dashed? Hit update. And no dash, but you can see, so, that bounce we got, I told you about, was going to be a failing rally. Got right near the Stark bands, bounced up to the 20-day EMA, back down. And, it's still pretty, pretty negative there. It didn't get quite up to the upper Stark bands on the daily chart, at that point. So let's look at, we look at the same thing in the S&P. I have an additional indicator that I'm working on a trading lesson for my subscribers on the Mcclellan Summation Index. That's this green line here with the moving average I use over it. You can see it diverged. It formed lower highs. This is based on the S&P 500 data, and has been pretty negative since up around here. AD line, S&P AD line, in a downtrend. It's made lower lows, lower highs, and is still in a corrective mode. No signs yet that this is over. And if you look at the NASDAQ, same thing, the Mcclellan Summation Index, based on the NASDAQ 100 data, it looks pretty sick too, as does the AD line. And so all those are still pointing lower, and they're not suggesting that there's any, near-term likelihood of other than a short-term tradable bottom. Let's see. Looking for new good questions. I want to ask, well, when the AD line goes back above its moving average, then the rally could be well underway readily. Sure, that's that's possible. Generally, what happens is you look at the slope of the moving average, and so you could say that, I don't know if you can see my X right in here, but it moved above it. Let's say right here we had a sharp setback, which is a buying opportunity. So you have to use your risk parameters. I rarely chase market, and you also wait. There were some other good opportunities. Sure, we're a bunch above the low, but we still have, it looks like 6,600 up to 7,900, which is almost a 15% move left in the market. So it's all relative. I'm not sure where that came from, but okay. So let's see, type measures. All right, so same as NISI on the stock charts? No, not. So let's, so the Great. It looks like I've answered all the questions in the 80 line, 31 minutes in, so I'll look at this briefly. I get periodically messages from people say, well, I use Bollinger Bands, and, I don't understand why Stark Bands are better. And, I've known John Bollinger. I mean, before he developed the Bollinger Band, I was doing a regular phone-in interview with him every week. So I've known him for like over 30 years, and he does excellent technical analysis, really smart guy, does nice work. I just found the way I interpret it, the Stark Bands were more useful to me. They were developed by another old friend of mine, Manny Stoller. So let's look at these. I played both of them. So the dashed line here are the Stark Bands, and the purple ones are the Bollinger Bands. So I use the Stark Bands to help enter and exit positions because, the formula is different enough. These are based on the average true range added to a moving average, where the Bollinger Bands are a standard deviation play. Now, what you can see the difference, and the reason I like them better is if you look right in this phase right in here, you can see that the width between the two dashed lines stays fairly constant, throughout this uptrend, but you can see the Bollinger Bands expand dramatically, okay? So that gives you no lower parameter of support. Oftentimes they'll give you the same sort of signals, like right where this dashed line is, both were near the upper channel, and up here they moved above both the Bollinger Bands and the Stark Bands. That was in early 2018. Of course, on the sell-off, they never came close to the Bollinger Bands, and they did come back to the Stark Bands. Similar situation in September. You can't really see in the upside, but the Bollinger Bands was more accurate there. We got up close to the Bollinger Bands, not the Stark Bands on the S&P 500. So that's the other one. Once again, here on the downside, we dropped well below the Bollinger Bands on the end of December, right, just perfectly matched the Stark Bands, telling you that was a very oversold condition. Let's look at a couple more. Let's see. Let's look at Micron, a favorite trading stock of better, nice and volatile market, and you can see, we got a low down here, hit the lower band, rallied up to the Bollinger Band. I've identified a couple of squares here where, we're extreme overbought conditions, and turning points, that the Stark Bands, don't ever, expand that much. You can see the expansion here. The upper was at 43 and the lower was at 30.58, whereas the Stark Bands were at, if I can read this, they were at 36 and 30. So a big difference there. Somebody wants me to use a multiplier of 1.5. Sure, I can do that. There you go, 1.5. Still expands a lot, does, maybe better, I don't know. Obviously, as I said at the start of this, it's really important that you find tools that, I would never for a moment say you can't use Bollinger Bands and be a successful trader. I just use Stark Bands, and, they aren't used by many people because many people don't understand them. And if you look on the internet, I think I'm the only one that writes about them accurately. I happen to have the pleasure of traveling around the world with Manny to various places teaching technical analysis, and a lot of people teach that they're just the same as Bollinger Bands, and they're not really. And if you look at the math, you can see why they wouldn't be the same. So let's see, we have one more Stark Band chart here. I can go into that more. Here's a weekly. Let's see the difference. We both catch the extreme points, but see, because the Bollinger Band can change so dramatically, I actually use these to take profit-taking orders. So if I'll look at, let's look at this chart right here. It's a weekly chart, so that the pivot points probably won't work quite as well, but we'll give it a shot. So it hit like, came pretty close to the R2 right up in here and the Stark band. So I look for a market to peak out in that or bottom out. This is the pivot. So this is the S1. We didn't quite get to it. Down here, we got perfectly down to the, we didn't, that's R1, but we got a little doji buy signal here. So that's another technique. I have greater confidence in what I'm trading or recommending when I see confirmation, of price levels from a couple of methods that are, somewhat independent. Somebody asked me if Stark bands are more efficient than Bollinger bands. For me, they are, but to the person who wrote this, I would say, convince yourself. I get a lot more information from. That's why I publish in my tables where they are. When we were getting stretched near, in April, they were like, some of them were like 1 or 2% from their weekly plus Stark bands. Now they're, they got down to their minus Stark bands just in, in the month of May. So it's a big difference in terms of what they've done. And we can, put up a chart maybe of the, let's see, this so you can see, the daily here. Let's see if the monthly will show up, and it probably not, but the weekly. No, you can't really say with these, but trust me, right up in here in April, the QQQs in particular, which was the strongest ones, were very close to those moving averages. So I wouldn't always ask about Apple. So, if any of you missed that presentation where we set up my indicators and stock charts, I just thought you'd kind of give you a little rendition here. The dashed red lines in this case are the Stark bands. You can see we got up near Stark bands there, Stark bands here, Stark bands there, just moved above it, and also I put the pivot levels in here. So, that was above the R2 here. And, it's been a pretty good slide. You can see that the RS, remember this is measures the performance of Apple versus the S&P 500, broke down through its moving average. And the OBV also turned negative in the start of May, and they're both still negative. So, based on my work, it's going to take some time and price action. We're getting into levels that are looking more interesting. You can see this low at 168.85. That'd be a level to watch. If you get down there, you can see that the lower Stark band right now is at 169. The Keltner equivalent at 169.31. So that could be an interesting level to watch. Is ETF vibers? So yeah, I feature these. I don't feature Bollinger bands in my publication. As I said here, let's see if you can see this. A lot of those charts, if you guys want to read about corrections, this article is posted on viperreport.com. Gives you most of the charts and a more detailed sort of description. It gives you some additional ones I didn't cover today. So give you a few more examples to look at how it operates. If you want more information about the AD line course, there's a link here. It tells you exactly what it includes, and it usually runs to me, well over 6 hours of one-on-one training, and it's sort of a test in between each sections, and I've had a lot of good positive feedback from it. So if it's something you're interested, there's some more information on it. Let's see. In the Viper ETF service, do you stay away from the 2 and 3 times? No, I do not. Actually, we're currently in the SPXS, the triple inverse bear fund. So I do recommend those. When they first started out, I tended to go for the single or the double inverse, but I found that the price performance was really didn't seem to be commensurate with the risk. The options, of course, are much higher risk, higher reward. That's the way it works. And so I find that's, we took, I think we closed out half the position last week. We took about a 7% profit or something. We're still riding the rest, but I'll probably be, if we get another push to the downside, I'll probably be looking to close that out and look for another opportunity to get back in. They trade very well technically, and, so they're a nice, market to take. So this is like SPXS. Can't really see the action, but you can see it's, up to 2258, and it's got a real key level of resistance right up in here. On balance volume here has been very strong. RS is sort of irrelevant, because it's based on the S&P 500. So, but pretty much that's all I've got today. Which I said, I was 41 minutes, so I'm close to my parameter. And I'll be sending out a recording of this at some point, probably early in the week. And please take the time. It shouldn't take you long to fill out the survey. I want to know what you like, what you didn't like, what you're interested in, what you're not interested in. And hope you learned something today, and I hope you have a great weekend. Thank you.